Okay. Okay, thank you everybody for joining us tonight. If anyone else comes, I'll let them in. I'm Erica Ollis with Camco. I'm a director, and we'd like to thank our board members, and we have some managers here present for joining us this evening for our board member roundtable. We've got our special guests, Ken Dash and Dennis Yost with Risk Strategies. Ken and Dennis are longtime partners of Camco and our associations, helping us get the best coverage for our associations, help us understand our claims, the market, what's happening as this, as we all know, changes from time to time. So we really appreciate their partnership with us and helping us understand this evening the market for the insurance industry. So I'll hand it over to Ken and Dennis.
Thank you, Erica. Hello, everybody. Good evening. Erica, I can share my screen, which I think may be helpful for the discussion tonight. Was that okay?
Sure, Ken, that would be great. Are you able to?
I am.
Okay.
All right. So normally I don't share my screen when we talk about things like this, insurance and market trends, but I thought it would be helpful tonight because if any of the board members or managers that are on the call want to get a copy of this after the fact, I'm happy to send it through to Erica, who could forward it to all of you if you would like it. So Erica and many of the managers came to Dennis Yost and I, who specialize in insuring community associations, whether they be condos, cooperatives, planned communities, HOAs, et cetera, and said, everyone asks, what's going on? What are the trends in the market? What's impacting premiums? What can we do to stop the bleeding and kind of make us best in class moving forward so we can communicate properly to our owners and really prepare for the future? And so I decided to put together this document to talk a little bit about the current trends impacting insurance coverage and premiums today, like why. And we're not just going to be talking about property impact, but impact on everything related to risk management and insurance. And I don't want to be long-winded tonight, and I do want to make sure that there are questions and they can be answered either in chat, which Erica can provide at the end of my presentation. But if something you feel, Erica, is important to address, mid-presentation, I'm happy to, as well as Dennis's as well. So Dennis and I work with associations like you and the boards, and the biggest issues that we see today are in this first bullet point. And, from the standpoint, why weather? Well, when you think about the fact that there were 25 $1 billion weather-related claims in this country in 2024, and we're almost over 16 $1 billion events through the first half of 2025, you can understand that has a ripple effect on everyone. So regardless of whether or not you had that weather-related damage, if it's happening across the country and there's only a certain number of insurance companies that are willing to insure community associations, while they may take their pound of flesh out on that area that had or has storms or other weather-related claims that are ongoing, they do have to divvy it up around. And, so that is a big item. And it's one of the reasons why rates have gone up so much over the last several years. It's because of the weather-related claims and just how unpredictable it is. I mean, just look what happened on Thursday in our area, in the greater Philadelphia area. I understand we have some New Jersey. I mean, that storm took out so many trees and so much power, and the insurance impact just here on the I-95 corridor was tremendous. And that was a tiny little storm. So you can imagine what it's like to have billion-dollar storms and to have 24 or 5 in 2024, and almost 15 or 16 already in 2025. it obviously has a tremendous impact on premiums and coverage. So weather. Next, water damage. We all know it. Every building, every community has some shape or form water damage claims. There are pipes that burst. There's washing machines that overflow. There's toilet supply lines that break when you open. There's backups of sewer and drains. There's sprinklers that freeze and cause damage or get hit. I mean, there's so many nuances as it relates to water. And so the insurance companies are taking a huge hit based on the sheer volume of water damage claims, both from a frequency and now a severity. Because keep in mind, the cost to repair or replace cabinetry or flooring today is so much higher than it used to be, just based on just the sheer cost. Construction costs are up, inflation, et cetera. It's so hard to get goods. We don't know what's going on with tariffs. So a simple water damage claim yesterday, similar to a car, like you get a little fender bender. There's no little fender benders anymore. You get a little fender bender, it's in the thousands and thousands of dollars because the cost to replace or repair a car is so much higher. Same with your unit. And so these water claims are really impacting the insurance industry and impacting the coverage and premiums that insurance companies have to charge to stay in the business of insuring community association. We'll talk a little bit more about what associations can do to improve that experience. In the last year, the words crime score have come across my desk repeatedly. In the greater Philadelphia area and all around the country, insurance companies are now using technology to understand what your crime score is, not just in your city, but on your block. And essentially, depending on what that crime score yields, if you've got a higher than normal crime score, and what is acceptable, 30 to 35 is an acceptable crime score. And anything over and above that raises red flags, both from a liability exposure, because they're concerned about potential assault and battery. They're concerned about vandalism, malicious mischief, etc. The crime score is elevated. And unfortunately, if anyone here is in Philadelphia, meaning in an association in Philadelphia, that crime score has gone through the roof. And many insurance companies now are pulling out of writing business in the greater Philadelphia area, but also in the suburbs, because Philadelphia now has one of the most challenging jurisdictions from the standpoint of litigation. The Philadelphia Court of Common Pleas and Pennsylvania is now the #1 judicial hellhole in the country. And yes, there is a website called judicialhellhole.com. I know it's weird, but there is. So when you have a chance, go online and look up judicialhellhole.com, and you will see our proud city of Philadelphia and Pennsylvania as the #1 judicial hellhole in the country. So we're #1 in something. We won the Super Bowl, and now we got this. But it's a problem because insurance companies don't want to be involved in that litigation environment. And because of that Philadelphia Court of Common Pleas and the crime score, it's creating a major problem for them to even figure out how to underwrite what to charge for liability insurance. Now, couple that with something called third-party litigation funding. What the heck does that mean? Third-party litigation funding should be illegal, but it's not. Private equity firms, large private equity, large money, have decided to make a business out of funding litigation. So how do they do it? Morgan & Morgan is an example, and I use them because of the multiple commercials, the billboards, the constant ads, etc. So Morgan & Morgan will now have a case. Normally, that claimant may have slipped and fallen on your property, would settle for $25,000 or maybe less. But now, this litigation funding company is providing Morgan & Morgan with money to not only pay this claimant, but to also fund litigation to trial. So insurance companies now know that they have to deal with potentially going to a jury trial or a trial on a situation that would otherwise have been settled for 10, 15, 20,000, $5,000. And it's raising the level of what these settlements are because they don't want to get in front of a jury pool if they can avoid it. A, because the cost to take it through trial, and two, the potential downside of a jury actually making an adverse decision. And so if you have a chance and you want to look up third-party litigation funding, you'll get a better sense of really how serious this is, and is only becoming worse with the amount of money and private money that has gotten into this. What else is a trend that's an issue? So in the very old days, 20, 25 years ago, there weren't real estate umbrella programs. You as an association had a primary general liability policy, and maybe that same carrier wrote a 1 million umbrella, a 5 million umbrella. Umbrella is to protect the association for a catastrophic third-party claim made against the association. Somebody could trip and fall, hit their head, bodily injury claim, someone gets run over in the parking lot. You know, these are the types of claims. Someone drowns in a pool, just trying to add some added protection for the association for the catastrophic claim that happens every, not so often. But real estate umbrella programs started to become fashionable, and these programs started putting out limits of 25 million, 50 million, 100 million, 150 million of protection for virtually nothing, for $5,000, $10,000, $15,000. And so why wouldn't every association buy $100 million of coverage if it was only going to cost $10,000? Problem is these umbrella programs just have fallen by the wayside. It's like a domino effect. You've got 10 carriers within that umbrella program. One decides to pull out because they don't have enough capacity to participate anymore. And like a domino, the program falls by the wayside because they need that capacity for their other clients, for their other insureds. And so now these real estate umbrella programs have either all gone away, or the ones that are still around are charging not 10, 20, 30% more than they used to, but 100, 200, 300% more than they used to, because they realized that $10,000 for a 100 million umbrella was ridiculous, and it should have been $100,000 for a $100 million umbrella. And so what we're finding is that many associations either can't get the higher limits, or they're reducing their limits because the cost just is so high. So that is something that you'll all be faced with if you haven't already. Life safety has become very, very critical. And insurance carriers historically weren't as concerned about not fully sprinklered buildings. Now they are. They're concerned about it if it's older frame construction. Now they're concerned about it if it's a high rise and it's not fully sprinklered, because they're concerned about the life safety and people getting out. So sprinklers really aren't necessarily a concern for insurance companies as it relates to property in certain construction type buildings, but it is a major concern with respect to liability and life safety. And so because of that, insurance companies are not quoting buildings that are not fully sprinklered. And when you have less insurance companies willing to quote, and which equals less competition, that means, unfortunately, potentially higher premiums for associations. We'll talk a little bit about what you can do, short of spending millions of dollars to sprinkle your building, to sell yourself in a better light to insurance companies. Frame construction, I mean, because of the cost to replace, you used to see $100 a square foot on frame construction. Now it's $300. And so you take that and you say it's 3 times. So an insurance company had been insuring a building or property or location for 10 million 10 years ago, and now it's 30 million. They don't have the capacity or reinsurance capacity. The buildings are close. They're concerned about a fire. They're concerned about that fire spreading quickly. And not just within that one building, but potentially other buildings that may be 50 or 75 feet away. And so it's getting harder and harder to ensure large amounts of frame construction. And so, again, an issue, and we'll talk about some things that our associations can do and you can do if you know that you have frame construction. And then lastly, isn't this fun? I mean, it's like, this is horrible, but I got to tell you what the problems are. Fannie Mae. Most associations, 70% plus, your owners obtain Fannie Mae back loans. Fannie Mae's insurance guidelines have become so strict that unless you carry certain limits and also certain types of coverage, you are not eligible as an association, and certainly your owners are not eligible for a Fannie Mae back loan. And so with the changes in the insurance environment, with some associations just not being able to comply, that's causing a ripple effect and a problem for owners being able to sell their units. And obviously, to comply, associations may have to add coverage, which increases costs. So I just want to make you aware that Fannie Mae is having a tremendous impact on associations and what they must do. So I want to stop there, Erica, because that was my first bullet point, which I thought would take about 15 minutes. It took a little bit longer. And see, are there any immediate questions before I jump into the strategies that we recommend to mitigate risk and maintain comprehensive coverage at competitive costs?
Ken, we have a question from Lauren Hart. Lauren, if you don't mind unmuting first, please.
Thank you. Can you hear me now?
Yes.
Thank you. Very interested in the water damage question. And just I'm trying to understand the liability of the co-op and the liability of the individual unit. So say there's a unit pipe that's above my newly remodeled kitchen. So it's in the unit, the condo's wall, but it leaks and floods my whole unit, wiping out $100,000 of a newly remodeled kitchen. Does the unit, the the co-op insurance policy, we're with Penn Center House, cover some of the damage, or is $100,000 all on me?
Well, because you're cooperative and because I have not read Penn Center's governing documents,
Okay.
I don't know.
Okay.
I will tell you that in the state of Pennsylvania, at least, since we're talking about Philadelphia, if you're a condominium, the association would be responsible to insure your unit as it was originally conveyed by the developer. Knowing Penn Center House, that's probably builder's grade. And any betterments and improvements would be the responsibility of the owner. The deductible of the association would be the responsibility of the owner, and to be insured under the owner's condominium unit owner's insurance policy. Stuff goes wrong in buildings, and because of that, regardless of the fact that it wasn't emanating from your unit, it will still be your responsibility to insure. And then your insurance carrier, meaning your personal insurance carrier, would then have to evaluate, pay your claim, and determine whether or not there was negligence on the part of the association that caused your damage, or if it was just a common element failure, and really it was no negligence. And if they do feel there's negligence, then they would subrogate against the association and try to recoup whatever they have paid out. So I hope that answers your question, but happy to speak and look at Penn Centers individually for you when the time is right. because I could, easily look at your documents to see if it reads similarly to the Pennsylvania Uniform Condominium Act, or if it's bare walls. It really does depend, because you're cooperative, it could be anything.
Thank you.
Erica, I have a question. I don't know how to raise my hand.
Oh, go for it, Joyce.
I know how to unmute. You said Fannie Mae has requirement. What is the minimum or maximum that Fannie Mae requires the insurance to cover, or the coverage for the association? Does it depend on every different association, or is there a standard number for everybody?
It varies. So they require at a minimum that the insurance company or a representative of the insurance company or an outside appraisal demonstrates that 100% of the replacement cost value of the building, including the units, if you're covering the units, pursuant to whatever act or your governing documents, it has to be 100%. That number could be 100 million, could be 20 million. It just depends on your building or buildings. They require agreed value, meaning no co-insurance. They have inflation guard requirements. I won't even get into what inflation guard is, but it's something that they now require. They have caps, meaning if there's a deductible and it exceeds a certain maximum, that maximum being 5% of the building value, they won't approve you. They have requirements with respect to crime, where it has to equal 3 months of income plus reserves. Dennis Yost on this call could probably opine more than I can on it, but I will tell you that the requirements have gotten incredibly strict, and quite frankly, to the point where you're almost beholden not just to Fannie Mae, but to whomever the lender is reviewing the certificates of insurance, because if they look at it wrong, it takes up a lot of our time in a good way to make sure that the certificates of insurance actually do represent, and you really need to make sure whoever your insurance broker is, that they understand Fannie Mae guidelines, because it could truly impact if someone can even sell their unit. And then if they can't, there could be a lawsuit against the board for not having the proper insurance coverage to comply with Fannie Mae. And all of a sudden they're going to sue you for the fact that they could now not sell their unit, and they're going to blame you.
And on
So
the,
Well,
go
I
ahead.
don't understand how this works. If you have a community where the buildings are not covered because each homeowner is supposed to cover their own property, it's an HOA fee simple. So it's not like a co-op or a condo where you have to have coverage for the building and the owner is responsible for the interior. So if you have no building to cover.
Great point. I made the assumption when I said Fannie Mae that the majority of the board members on this call were not necessarily HOAs where they have individual dwellings on the property that are the responsibility to be insured by the homeowner. And really it's just common area liability, maybe a clubhouse, a pool, etc. You're going to have less of an issue with Fannie Mae than a community association that is a condominium or cooperative.
Okay.
But even, Ken, what I was just going to say briefly about like even HOAs, I think the one that we as a management company see the most is like the crime limit when it comes up for a sale. And usually what we see though is there is a fix for that. So if the bank comes back and says you don't have sufficient crime or fidelity coverage for the amount of money that you have in the bank, we'll say, okay, well, can you give us, we'll ask the agent for a proposal for the amount of coverage that the bank wants, because this is kind of what it takes to get the sale to go through. And then you turn around and give the board that proposal. So there is a fix usually in that case. And crime coverage usually isn't very expensive. I mean, does that make sense, Dennis or Ken, what I'm saying? Or
Yeah, it
is
makes
that-
perfect sense. Typically, Fannie Mae wants 3 months of all fees plus any reserves you
Yeah.
have
Okay.
Yeah.
In the spirit of time, I'm gonna move on to, is there hope? And I think there is, because there has to be. And so what we've tried to do over the last several years is help mitigate risk in order for you to maintain the comprehensive coverage that you need as fiduciaries to comply with the governing documents, any acts, any may. I mean, basically to uphold your fiduciary responsibility. But it takes a lot of work and a lot of commitment, because we're recommending that associations really take a hard look at their rules and regulations. And if you haven't already done so, include mandatory preventative maintenance requirements. Every property is a little different. So if someone has hot water heaters in their property, we want to make sure there's a hot water heater replacement program every 8 years and documented. And when it's replaced with an automatic shutoff valve. If there's washing machines, having and mandating stainless steel braided hoses. Refrigerator lines must be copper. They can't be plastic. There are various things that can and should be done in order to improve the risk. And by updating rules and regulations and making sure that they're followed, you're going to improve your loss history. It could be something as simple as, hey, we're frame construction. We can't have grills, just can't. If they're electric, so be it. But if they're within 10 feet, if they're on a deck, we can't have it because it's a fire hazard. If there's chimneys, they need to be cleaned, period. Once every 2 years, documented and inspected. I mean, so it's not a broad brush that we can paint over every different association, but please look at your rules and regulations. They should be updated, and your management company can help you with that. An insurance resolution, really important. Most of the documents are super old. And quite frankly, they probably don't require or mandate that owners must maintain insurance and must maintain insurance as an owner for the, tenants must maintain insurance. Don't really spell out much about the responsibility of the deductible. And so spelling out and having a very, very concise insurance resolution could make sure that if somebody has a claim within their unit and they don't have insurance, and that could create a huge problem if they don't have the ability to put Humpty Dumpty back together again. If they cause a massive claim because they had a candle and it fell over and there's a fire, and not being able to subrogate against that individual owner to recoup could have lasting impacts on the insurability of the association. So we're seeing more and more communities with guidance from their council put together insurance resolutions, which I think is a wise thing to do. Risk transfer. Most of the properties transfer their, need risk transfer. You have contractors, snow and ice removal, landscaping, plumbing, electric, etc. Any contractor that does work on behalf of your association, there should be some kind of wording, an addendum agreement. In addition to the certificate of insurance, naming the association management directors, officers as additional insureds on a primary basis. But on an agreement, especially on a large project, especially with companies like elevators and snow removal, there should be a set agreement where they must indemnify the association and management for claims resulting from their negligence. So if and when that claim does occur, and someone does have that slip and fall on ice, you can push and tender that back to the contractor based on contractual language. This risk transfer will help tremendously in improving your loss history, and helps tremendously when we demonstrate to insurance companies that you're thinking out of the box and that you're actually doing things with risk transfer. Important. Reserve studies. We need them. Insurance companies want to see how old your stuff is. Do you have reserve? Is it set? Is your roof, electric, etc.? Do you know when things are coming due to be repaired and replaced? And are your financials sound enough that you can actually take care of these things? Believe it or not, that has a tremendous ability and impact on what and if an insurance company will insure an association. And it's incredibly productive for future boards who may come in to see what's going on with your property, with your assets. So if you don't have updated reserve studies, you really should. It really helps. We have been working with associations to provide what's called a unit owner, and we even do an association preventative maintenance checklist. But let's focus on unit owners. Again, every association is a little bit different. But if we can have owners, if we can work with the head of maintenance or building engineer, manager, and tailor a preventative maintenance checklist to provide to each owner, which spells out things that they should be doing with respect to preventive maintenance to prevent water damage claims and other types of claims from happening, they just may not know what to do and how to do it. And to put a 2-page, 3-page document in front of them in order to maintain their home as an owner is incredibly important. And so we found that by having that checklist, it dramatically improves the loss history of associations and claims from happening. And then lastly, looking at claims on a quarterly basis. You should be getting a quarterly loss report from your broker outlining what claims have occurred. That way you can look as a board to see over the years, what have we done to correct that situation from happening in the future. And if there are open claims, staying on top of them with your insurance broker and insurance company to make sure that some big claim is just not sitting out there and gets paid when maybe you have input as to what's going on. I can't tell you how many times I see a $200,000 reserve on an open slip and fall claim that should have been closed out, and insurance companies are not quoting because they see awful loss history. So you as a board and management should be looking at these and demanding these quarterly so you can stay on top of where your claims are and why they are happening. So those are the strategies that we like to recommend to mitigate risk and for you to maintain comprehensive coverage.
Ken, before you move on, I just wanted to reiterate with everybody how important we feel it is. Some of the items Ken mentioned, like the programs you can have in place that are very simple, like rules requiring your chimneys to be cleaned every 2 years, replacing your water heaters every 8 or 10 years, you know, whatever's recommended by your insurance agent or your plumber, your contractor, your trusted, you know, third-party professional. These things are so practical and we see them work a lot. So I think it's very important. If you don't have anything like this, talk to your manager, talk to the board, and implement some of these programs that are going to really help you guys in the long run. And Ken, I had a question about that. Besides helping us with our loss run, do programs like that, do you convey that? Do you guys as agents convey that to the carriers, or is it more just it helps us with the loss run?
No, we convey it.
You do? Okay.
I mean, when I say we, let's assume that an insurance broker is doing their job advocating.
Mm-hmm.
In their job advocating, they shouldn't just be sending loss runs with an application, please quote. It should be, here's a narrative. Yes, I know that they had this slip and fall, but this is what they've done to prevent it from happening in the future. Yes, I know they had this water damage claim with this sprinkler pipe burst, but here's what's going on. So we convey all of these things in a narrative when speaking to underwriters so they can understand, look, you have insurance for a reason. Claims happen, but we need to make sure they understand that you take it very seriously and are doing things to try and prevent them from happening in the future. That's all.
Okay, thanks.
So I want to jump. Understanding changes today in policy terms and conditions that are affecting communities. So what are we seeing today that we never saw in the past. And I think it's only going to get worse. So, number one, as building values have gone up to replace, you would assume that deductibles should go up. I mean, if it costs more to replace, why should the deductible be the same deductible as it was 10 years ago? It shouldn't. So insurance companies have taken another tack. To stay insurable, they're increasing water damage deductibles. In some cases, I've seen regularly $50,000 to $100,000 deductibles for water. Or they're applying what's called a per unit water damage deductible. So if it's a high rise and it's a 20th floor and it hits 10 units, each unit owner may have a $25,000 deductible that they turn into their homeowner's carrier to satisfy. It keeps those buildings insurable because it keeps the loss history with the association's insurer hopefully a little bit better. In non-high rises, they're still doing it because it doesn't take much for water to travel all over. So just keep in mind that if you don't have it now, you will either a per unit water damage deductible or a higher per occurrence water damage deductible for your association. So I would be prepared for that. We talked a little bit before about crime score. Insurance companies are now excluding, in some cases, assault and battery and abuse and molestation. They're concerned about the fact that someone's going to get hurt, sexually assaulted. People carry guns. And I've never seen so many carriers now looking to not cover assault and battery. Also, because there's children in most communities, they want to put on abuse and molestation exclusions. We push back hard and we're successful most of the time, but I do believe that this is going to increase and you should be aware and ask, do we have an assault and battery exclusion? Do we have an abuse and molestation exclusion? Could really leave you as an association exposed significantly. We're starting to see insurance companies put on deductibles on liability. Remember, property we know has a deductible, but we've never had a deductible before for liability. If someone slips and falls, our insurance company immediately defends it from $1. Well, now all of a sudden they want to put on $5, $10, $15, $20, $25,000 deductibles for liability. It's trend because they're seeing social inflation, more people wanting to slip and fall, plaintiffs bars. So there's a lot of activity going on. We push back, but keep in mind, this is something that you should look for and not accept without pushing back. If someone says, oh, you now have a liability deductible. Well, is it per claim? Is it per occurrence? You know, what does it all mean? So be aware of it. Building values. If you have not already seen your building's value increase over the last 3 years significantly, you will, because the cost to repair or replace is just significant. It just is. And again, without knowing where things are going with tariffs, insurance companies are on a mission to make sure that they're insured the value. And with what I mentioned about Fannie Mae earlier, I know that the Joyce with the HOA doesn't have the issue, but those with condos and co-ops, et cetera, do. And if Fannie Mae says, I want to see proof from your insurance company that you're insured to 100% of value, well, there's what's called a Marshall and Swift replacement cost report. And if that replacement cost report says 20 million and you're only insured for 12, you're not going to get a Fannie Mae back loan. And the insurance company is going to want to increase you to 20 million. Why is that a big deal? Because an increase from 12 to 20 million is an increase of 40%. And even if your rates stay flat, you're going to get a 40% increase in property premium because your building values are increasing. So I don't want there to be surprises for all of you when you see the fact that your values. Now, if you disagree with what the insurance company is saying, you have the right to go out and get your own independent replacement cost appraisal and try to challenge what an insurance company is stating that your value should be. Lower umbrella limits, we talked about it earlier, the demise of the real estate umbrella program. So you're going to have to start talking with your broker about what is the right amount of umbrella liability insurance to carry. What is benchmark today? And it's a tough one because obviously catastrophic claims can happen. But I can tell you from my personal experience of insuring some of the largest condominiums in the greater
That's
Philadelphia.
all right.
Yeah. The last
I'm
30
muted for
days.
sound. It's good. Okay. Did you play for?
No, she had been told.
That I have not had a liability claim that has exceeded $4 or $5 million. It doesn't mean it can't happen. But unlike Surfside, I do believe that most of our board members are actually very diligent, where they ignored everything there, which is why that collapse occurred. I do believe with proper management like Camco and a reserve study and the board and engineers that, you know, those claims are very far and few between. So you're going to have to make decisions about, you know, what's the right limit. Normally it's what can you afford that is reasonable. If you had 100 million, maybe we're going to have to do 25. If you had 25, maybe it's 10. And your broker really should help you with that benchmarking to make sure that you're insuring to at least for 90 to 95% of benchmark. And I think you'll find that if you insure for at least 10 to 25 million in umbrella, that will and should cover 99% of the claims that you will ever see. And quite frankly, if it gets over 25 million, I don't know if 50 or 75 million. So I think you're doing your due diligence as a fiduciary. And then lastly, directors and officers liability. We're seeing a lot of non-renewals due to claim frequency and severity. Everybody wants to sue. Owners want to sue for everything. Whether it's support animals or I should have been on the board and the vote was wrong. We've seen everything from directors and officers liability claims, discrimination, not proper handicap access. My value of my property is down because the board made this decision. The board breached its contract, meaning the governing documents. It didn't do it by the letter. We just see more and more people are just angry and they're just suing. And D&O insurance used to cost $1,000, $2,000, $3,000, $4,000 a year, maybe. And so, like the umbrella real estate umbrella programs, D&O insurers are saying, "It's just not enough here. There's just not enough premium based on the sheer volume of lawsuits and the cost to defend these lawsuits." So many are just non-renewing, and others are dramatically increasing D&O premiums and deductibles. So it is important that you file D&O claims because if you don't, insurance carriers can deny a claim for late notice. But just keep in mind that we are seeing, by and large, more directors and officers liability claims than we've ever seen in my career. So I'm going to stop there. And just my conclusion is, while it sounds a little gloom and doom, there's still a tremendous amount of insurance companies out there willing to write insurance policies for associations. But boards and managers and brokers have to take a much, much more proactive approach if you want to get the best price and the best coverage with the best insurers for the long term. You sit back and are reactive, you will not. And that really is the message of this presentation and seminar is, yes, there's hope, but it means a lot of work on everybody's part.
Can we have a couple questions. Paul is asking, Paul has a reserve study question.
Hi, yes. So for the requirements of the reserve study, what we tend to see with our reserve studies, the last few we've had, they're really just actuarial numbers, and they don't really mean much in terms of, life of equipment or what needs to be done. So what we do is we combine that with our vendors and contractors and have them give us more I would say more accurate estimates of timing and cost, and kind of blend that together in our own kind of long-term capital study. Is that something that the insurance companies would be interested in seeing, or they're strictly looking at the reserve study, which frankly I think makes us look worse than we actually are, because some of the way they do like full funding rather than the way we actually work is a lot different. I tend to find those to be it make us look worse than we are. So what do they really look for?
Yeah, Paul, it's a great point. Yes, that helps. And, I've seen different types of reserve studies. So I've seen the kind that you were mentioning, maybe for your association, but I've also seen ones that do incorporate the life of where it really does incorporate the life of the equipment and when it should be replaced and what they have in the budget in order to do that over a period of time. So the more information that can be provided, the better, obviously. Yeah.
Okay, thank you.
And someone else had a question about, and I don't know the person's name. It says, "Don't email me." The question was, are those claim limitations between homeowners or between staff and homeowners? So I don't know what that pertains to exactly. I'm not familiar with staff claims.
I think maybe what and I'm making an assumption. Perhaps they were referring to the claim limitation with respect to assault and battery and sexual abuse and molestation.
Oh, okay.
So, and yeah, assault and other crimes. Thank you. So if a staff member is assaulted or injured, there should be workers' compensation insurance coverage in place, which will cover the medical expenses and lost wages for that particular staff member. Because you have workers' compensation insurance at your association for that employee, they are really limited in the fact that they truly can't sue the employer because you maintain workers' compensation insurance. As far as sexual harassment or sexual abuse, if you maintain a broad-based directors and officers liability policy, that policy will include employment wrongful acts. And those employment wrongful acts include sexual harassment, discrimination, etc. So I think you'll be properly covered as long as you have workers' comp and a proper D&O policy.
Okay, thanks, Ken. And then Tim Hall is asking, I just had it. Can an HOA require a homeowner to carry homeowner's insurance, particularly when they own their property outright? And that's maybe more a question for like the association's lawyer. I'm guessing more than Ken and Dennis, no?
And I think the answer is probably yes with an insurance resolution. And I'll tell you why. Do you want, and sometimes homeowners associations, it's not just a standalone dwelling. You could be, what do you call them? Clusters. And so do you really want a burned out home sitting in the middle of everybody? It's going to cause major problems from a safety perspective, mold, et cetera, all that. It's also going to bring your property values down. So I think absolutely it can be mandated even in an HOA because of all those reasons.
But can I also ask that, but it is without some particular action on the part of the board and the management company, that shouldn't be implied, right? I mean,
I don't know. I'd have to read your documents. It may already be in there. It's really a legal question, Tim. But from a practical question, from a risk management question, absolutely. Do I want to be next to someone that I don't know if they have insurance because they don't have a mortgage? Maybe they decide they didn't want to carry the coverage. Maybe they don't even know. So I think it definitely is something that should be explored.
I'm sorry, thank you very much.
Yeah, and I would say, Tim, too, where I've seen that in governing documents that requirements you carry homeowners Coverage, I've never seen a stipulation about it being as long as there's a mortgage, or like there's never a reference to whether or not the unit is owned outright.
I bring this up for two reasons. One, a tree fell on several units, and one still remains unremediated. They're having issues with their insurance company. And we wonder if the HOA could get involved to help that along. The person might be out of their depth. And in another situation, a house flipper came in and they were also impacted by the tree that fell on them. I happened to find out that they didn't have insurance because I met with a borough official with that homeowner at the time. And they asked me, what should I do? And I said, well, you're going to definitely want to contact your insurance company. And she said she did not have insurance. Fortunately, they were contractors and they were able to do the work themselves and have. But this is a question that been on my mind for a long time. And anyway, I definitely want to follow up on that with the management company and our legal representation. See how we can tighten that up.
Sounds good, Tim.
Sounds good, yes.
Thank you.
Yeah, thanks, guys. And then we've got a question from Ian. It's kind of a long question. I'm going to read it. I have a question on a specific scenario. I have certificate of insurance on my part. In the event that I'm an independent contractor carrying out electrical tasks for the HOA and happen to fall off my ladder, what type of claim would be appropriate if I am unable to work because of an injury sustained in the fall? If my coverage doesn't completely cover it, how would I file a claim for lost wages? If I have medical bills that need to be covered, if my coverage doesn't completely cover it, how would I file a claim for these costs?
In the state of Pennsylvania, are we talking about PA?
Ian, do you mind giving a little more background? Are you in would this be in PA?
Yes, this is in PA, right outside of Philly.
Great. So in the state of Pennsylvania, even if you're a sole proprietor, you do have the ability to get workers' compensation insurance through the State Workers Insurance Fund to protect you for lost wages and for injuries sustained when you're working. Normally, we will not recommend, nor do most associations allow anyone, any contractor, to do or perform work at the association unless they can show evidence not just of their general liability insurance, but also workers' comp. The concern being if they don't carry workers' compensation insurance and they do fall, they could state that they, A, were maybe, hey, we were an employee of the association, or B, I was put in an unsafe work condition. And so normally we would strongly recommend, especially with any trade contractor like plumbing, electric, et cetera, that even in the sole proprietor situation, that workers' compensation insurance is required because it can be obtained. I know there's going to be exceptions with dog walkers and housekeeping and certain types of independents that come on premises that we're gonna not have that requirement. But for serious work, and I consider plumbing, electric, et cetera, serious work, it should be strongly considered.
Ken, then we have an owner who asked, then why would the HOA have to carry workman's comp insurance?
Well, one, your governing documents likely mandate it, but two, for $500 a year, if there is a contractor that even if they say, here's my workers' compensation insurance, see my certificate, and it's not valid at the time of the loss, they can still claim workers' compensation insurance against the association. It really is a fail-safe to protect the association in the event you have an uninsured contractor doing work there. And, oftentimes, you may not even know.
Yeah, I'd also like to piggyback on that, Ken. Those workers' compensation policies also provide coverage for volunteers. We've had multiple claims where a volunteer or a committee member will be on the landscaping committee, let's say, just watering plants or helping do something. They slip and fall, get hurt, and now they have medical expenses and lost wages. That policy would trigger coverage for them.
That's great. Thank you, Dennis. And someone else, or Ian had another, he said work comp related question. I would say if
yes,
it's
it was
association. Go ahead.
it was around the lines of the volunteer work. My understanding is that there is in past nonprofits that there is a certain duty of care threshold that should be met. Is there something as an HOA that we can do to help mitigate that? Specifically for volunteers.
I'd have to give that some thought, Ian, because duty of care depends on, the various activities. I get questions a lot. Hey, this committee wants to do X, Y, and Z. Can we do that? Should we do that? I think oftentimes it's just a phone call to your risk manager, directly or through your property manager to see if it's something that's acceptable. And maybe it's, a waiver, that they may have to sign, depending on the circumstances. So I think we have to take those things on a case by case basis, depending on what exactly it is that they're volunteering to do. There have been situations where I've said absolutely not.
Mm-hmm. Like in a good cases, we have a volunteer at a pool party in the early summer. If they trip and fall, what sort of thing can we do to mitigate that from a liability point of view?
Absolutely. And one of the ways are, if they trip and fall due to the negligence of the association or volunteering on behalf, they would likely sue anyway, whether they were volunteering or not. Meaning if they were just out there, having fun at the pool party and there was a unsafe condition and they slipped and fell and hurt themselves, they would probably file a liability claim against the association for their medical bills, for their pain and suffering, etc. I think
so that really means we need to protect ourselves from like a D&O or a liability then.
It's general liability. It's your general.
Make sure we're not going to get in trouble if a general person trips, just to make sure that we have adequate coverage for those scenarios. We have a swimming pool that is very heavily used. So that is a concern about making sure that, we're not opening ourselves up.
Yeah, I mean, Dennis's point is a good one. Obviously, you want to do the best you can to mitigate, and video surveillance and this, that, and the other, but you can't watch everything. You can't mitigate everything, and that's where insurance does come into play. And having that workers' comp, as Dennis mentioned, or having general liability and having the umbrella is what you need to help those claims. And then having potential video or incident reports and risk transfer only can help you in defending yourselves as an association in the event a claim is ever made against the association.
Ken, thank you. One more question. I know we're just about wrapping up here, but we have Grant asking along the lines of Ian's questions. I recently learned that our HOA is paying for workers' comp and EPLI. Is that employment policy liability?
Employment practices liability.
Employer practices liability. Thank you for answering the WC need questions, but what about employment practices liability?
Sure. Employment practices liability can cover first party claims, meaning claim employees, or what we call third party. Third party would be someone who's not an employee that files a claim against the association because they feel that they were discriminated against or that they were sexually harassed.
Okay, you can see the difference. That makes sense. Thank you.
First party, Erica, could be anything. It could be hostile work environment. It could be wrongful termination, failure to hire, failure to promote, sexual harassment, and so on and so forth.
Is that specific for employee or volunteer or just general personnel who want to interact with the board?
If it's a volunteer, that would be considered a third party. And that would be discrimination, sexual harassment applies. If it's an actual employee of the association, there's a broader definition of wrongful act coverage that would apply. I'd have to, I mean, if you have an individual question, Ian, about scenario, happy to offline talk anytime to anyone here.
Okay.
Because I'm sure you're going to have individual questions, and Dennis, Yost, and myself would be happy to talk with you.
Yeah, pool volunteers are a minefield, especially if there's harassment or whatever involved. Any sort of protection
We
guidance.
don't recommend them. We swim at your own risk or have a third-party company as a lifeguard.
But I'm talking for volunteers, like if a volunteer is there and they harass somebody who's just attending.
Ian, as I said, it depends on the situation, the policies. Probably better if we speak offline.
Okay, no problem. It's just, everybody wants to sue, and
I get it.
we do try our best to make sure that we do have we are not falling in the negligent trap, or lazy trap, but there's stupid stuff you miss.
No question about it. We appreciate it. And actually, the fact that you're all here means a lot, because it means that you do care about your associations and your fiduciary responsibilities. And Dennis and I are here to help answer any questions you have anytime.
Can I have a quick question without raising my hand? I am a little confused because I hear people talking about employees, but when we have a management company that is working, the manager is the employee of Camco. It's not our employee. So I'm a little confused when you keep talking about employees.
Yes, but the property manager is an extension, Joyce, of your association. And so if that property management employee is being harassed by someone that is an owner or resident, et cetera, within the association, they can still not just file a claim against the property management company, but against the association for that discrimination, harassment, et cetera. So without the association carrying employment practices liability insurance, you would be there. And so in the definition of the policy, we extend the coverage for associations to include property management employees.
And I would say too, Ken, it's not just for property managers. I mean, many associations have employees there on site, they directly hire and engage with, individuals to work at the property. So it really depends on the setup of your association also.
Yeah, we see more claims from employees of property management employees against the associations than the actual management company itself, because it's not the management company that's actually doing the harassing. It's somebody that is either on the board or a resident or whatever.
Understood. Does anybody have any additional questions?
What was that insurance called that a HOA might protect themselves against that with?
It would be covered under your directors and officers liability insurance.
Okay, sure.
With an employment practices liability extension.
With that extension, okay. And just very quickly, is it enough for an HOA with rules and regulations that say, for instance, no certain activities on common area, and to send notices to the homeowners and in general to the whole property, and then something happens as a result of it? Is that even adequate protection for the property if a child or someone gets hurt doing those?
You're doing your due diligence and you're trying to get out what you can, but at the end of the day, if someone gets hurt, they're going to likely come after the association. And if you have defenses and waivers and signs and all the things that you're supposed to be doing, it will help you in the defense of that situation.
Thank you.
Ken, we have one last question. Julie Gledhill is asking, why is cyber coverage recommended?
Sure. You have private information on people within the association. Camco does, your cloud-based providers, etc. And ransomwares can happen, phishing scams can happen. And we want to make sure that you're protected for those potential claims that happen every day. Whether it's social engineering fraud, where someone wires money, a lot of it is going to happen out of your property manager and not necessarily you as board members, but it could. You can send an email. You could have information, with everyone's salary or everyone's private information, and somehow you get hacked and that gets out into the world, and all of a sudden that becomes a cyber claim. So it's really inexpensive for associations to maintain it. And as a result of that, we do recommend cyber.
So to piggyback on this, we have someone said, why would an HOA carry its own cyber policy if Camco maintains all records and systems? And then someone said, so are we liable for Camco employee on site?
I don't know if they're tied together, but the answer is a property manager, whether it's Camco or anyone else, and you can look at any property management agreement, is not like your typical contractor, not your typical vendor that's performing work for you, on a one-time deal, and there's going to be a lot of risk transfer there due to their negligence. Property manager is an extension of your association. It's an extension of your board. And because of that, management agreements require associations to defend, indemnify, and hold harmless management companies, unless due to the gross negligence or willful misconduct of the management company or management company employee. So that is why we recommend, most of the time, it's not gross negligence or willful misconduct. It's just something happens. And ordinary negligence will typically fall back on the association and not on the management company.
And I think the question about why would the HOA also have cyber, I think you answered that by saying the board members are also emailing. They might have a website. A lot of communities have a social media presence.
Situations where the property management's insurance is just not enough. Because think about it. If a property manager gets hacked, management company gets hacked, it's likely not just going to affect one association. It's going to be and have an effect on potentially all the associations. So we want to make sure you have your own dedicated coverage to protect you as an association. With that, I have to depart. So I want to thank everyone, and Dennis and Erica for setting this up. But if there are any questions, follow-ups, please let us know. And I just want to thank you all for participating.
Yeah, thank you, Ken and Dennis. Thank you so much. Their contact information is on the bottom of that form that I shared. So, and I also put their email. So if you do have questions, I'm sure they will be more than happy to answer questions a little more specific to your association. I want to thank you for joining us tonight. Like Ken said, it's a little bit of doom and gloom, but they tried to make it as educational for us also as possible and help us out here. So thank you all for joining us this evening. Take care. Thank you.
Thank you.
Ken and Dennis.
Bye.
Thank you, Erica.
Thank you guys.